When you look at the nature of production sharing agreements, well, of course, one of the key concerns we normally have is, are they structured in a manner that one is best in the interest of the public? For example, as far as disclosures are concerned, when we are entering some of these deals as the countries with the host minerals and the multinationals who are coming into the region?
Indeed, I mean, the fiscal terms establish a broad framework that determine how much of the divisible costs will be shared between the company and the government. And of course, rightly so, companies come here because they want to make money and they want to generate revenue out of it, and it's their right to do so. But the challenge we have on one side, Julian, is that many of these contracts are very secretive. It's really, really difficult to access many of these contracts. That's one. And secondly, the point I was raising about how you have the ownership of this or many of these companies being endowed. You have opacity both in contracting but also in the ownership. Kenya has, for example, a total of signed a total of 41 petroleum licenses over the last 8 years. 17 of the parent companies that own these petroleum rights belong to subsidiaries that are registered in tax havens, and these are according to studies that have been carried out by colleagues, for example, from the Kenya Oil and Gas Platform, that basically indicate that yes, it's good to sign these sharing agreements, but at the same time, you need to ensure that you know who you are dealing with. You're not ending up in a situation of a Russian doll. You are signing a contract with one company, but then the beneficial owner of that company is another company that is registered in Mauritius or in any other tax haven. And we saw this in the case of the expose that was done during the Panama Papers, where, as you remember, when Heritage Oil sold its stake to Tullow Oil, for over $1.5 billion. It was supposed to pay a total of over $400 million. And what did Heritage Oil do? They overnight shifted their residency from Bahamas to Mauritius for the pure purpose of wanting to take advantage of the Uganda Mauritius double tax agreement and avoid paying the capital gains tax that was owed to the Ugandan government. And the government fought this and won the case. And this is just an example and of in terms of how these companies can be able to structure themselves for the purpose of avoiding paying the rightful share of tax that they should pay.
And Alvin, now that you've mentioned the transaction that involved Heritage Oil and Tullow, let's just cross over to what happened recently between Tullow and Total, still in Uganda. What was your assessment? Of course, this has elicited so much concern around the tax that was remitted, and there was a bit of back and forth between the transacting parties and the government, as well as the Uganda Revenue Authority. What is the general feel around this?
I think that really the bigger question really there is, again, coming back, is around the revenue sharing, agreement. And largely what happens in cases like this is that when these sales are done, many of these transactions are routed through tax havens. They are routed through jurisdictions that provide secrecy and provide low taxation. So what happens at the end of it all is that while under the table, what happens is that many of these companies are using the schemes between the double tax agreement, particularly in the case of Uganda, the very, very regressive double tax treaties that exist between Uganda and the Netherlands, I think is one that would have significant impact. And our colleagues in the civil society sector in Uganda, this is one of the issues that they have been raising about the dangers that the DTA between Mauritius and between Uganda and the Netherlands poses, in particularly when you have transactions happening here and these companies are supposed to be paying capital gains taxes, but then the double tax agreement says that this double tax, the capital gains taxes are supposed to be charged at source, and many a time this the source is in the Netherlands, where these capital gains taxes are not collected. So achieving what you can call a double non-taxation in cases like that.
Alvin, my question is, many of the multinationals will tell you that it largely is about the contracts they entered right from the outset. So maybe the burden should be on the disclosure of the side of the governments with their people, as opposed to begrudging the multinationals. Don't you think?
Rightly so. Rightly so. Yes, rightly. Rightly so. I would fully agree with that. I mean, the responsibility of contract transparency rests with government. These are public resources. These are resources that are owned by the public, and I think that when you are signing contracts with these companies, it's really very critical that these contracts are put to public scrutiny. And I think in the case of Kenya, this is one of the things that we have been fighting, pushing again with the Kenyan government, that there's really need to ensure that if those governments are above board, then there is really no need to keep them secret and put them in public scrutiny. So that's some of the issues that we raise, which then when government says you guys are arguing because you don't have the correct information, then we say, please give us the information. Why are you keeping this information secret?
Cross over to Sandra to give her thoughts as far as whether Uganda got the best deal from this transaction of Total selling its assets to, or rather Tullow, I should say, selling its assets to Total. Sandra, you sit at the Revenue Authority. What are your thoughts on this?
We are happy with the transaction. We were able to close the transaction in line with the income tax laws. And as a country, we are being able to close this transaction means that we can move on to develop our oil and gas reserves and move towards poverty alleviation in this country. So what I'd like the viewers today to know is that Uganda did collect taxes on the transaction in accordance with the Income Tax Act, and the correct revenues were collected. As a matter of fact, we recently received about $23 million, which has been paid by the companies.
All right. Just to get some clarification from you, Sandra, before I cross over to another panelist, there was a bit of back and forth for those of us who follow this transaction regarding the capital gains tax. If you could just shed some light into this and why this was the case.
Yes, of course, there's a back and forth. There were issues as regards what would be deductible for tax purposes and what would not be deductible. But I must say that the government of Uganda and the joint venture partners arrived at a win-win situation where we were able to close the transaction with a win for both Total and Uganda. And as regards the back and forth, that is expected because as Uganda, we shall try to get the best deal out of this farm down. We've had a history of being ruthless at collecting taxes. We were the first country, if maybe among the first countries to collect capital gains tax on a farm down, maybe the first African country to collect capital gains tax on a farm down. So I must say we put in our all to this, and yes, once again, I must say we collected the correct taxes, and our biggest objective is to ensure that the reserves come out of the ground and decisions that have been made were in the best interests of this country.